It was supposed to be a quiet holiday week in the United States, and then Omicron hit. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on finding a path forward for the U.S. economy.
The new problem is, how do you land this economy softly?
Jillian Tett of the Financial Times on the anthropology of the markets.
We live in an economy of words.
And former Toys R Us CEO Jerry Storch on what to expect under the Christmas tree.
This year, probably more hot rock to sell out sooner than in other years.
It was a shortened holiday trading week in the United States, but that didn't mean we wanted for news, as President Biden finally told us who he wants to be running the Fed.
I'm nominating Jerome Powell for a second term as chair of the Federal Reserve, and I'm nominating Lael Brainard to take the position as vice chair of the Federal Reserve.
And then the president said he wants to help us all out at the gas pump by releasing some petroleum reserves, although initial reaction was probably not exactly what he wanted. The threat of a further Russian invasion of Ukraine, described by Richard Haas of the Council on Foreign Relations.
Well, I think the challenge for the United States and its European partners is to right now think about what do they need to do to deter Mr. Putin.
And then, the day after Thanksgiving, we got the news we had all dreaded. There's a new variant of COVID. This one first detected in South Africa and named Omicron. And governments around the world reacted, with the United States announcing new travel restrictions effective Monday. Here is European Commission President Ursula von der Leyen.
The European Commission has today proposed to member states to activate the emergency brake on travel from countries in southern Africa and other countries affected to limit the spread of the new variant.
And the markets reacted immediately. The S&P fell the most since February in a holiday-shortened session, pushing the index lower for the week overall. The Dow, meanwhile, extended its losing streak to 3 weeks. And the safe haven trades picked up, with the 10-year yield falling to just under 1.47%. Crude oil also dropped, falling 13% on the day. Certainly overall, a global rout on fears that a new coronavirus variant could spark fresh outbreaks. All of which left the markets with a good deal to chew on this week. So we thought we'd take this shortened week, this holiday week, to reflect a little more broadly for investors on what the phenomena are that we're facing. And there's no one better to do that than Gillian Tett. She is editor at large for the U.S. as well as head of the editorial board at the Financial Times. She's also author of a very important book called Anthrovision. Gillian, it's great to have you back with us. Thank you for joining us. Let's apply some of your anthropology, if you could, as well as your financial acumen, to what we saw this week with the appointment, reappointment of Jay Powell and the appointment of Lael Brainard as vice chair. And one of the things I'm curious about is one of the biggest issues we have in this country right now is inflation. And yet in the appointment, we didn't hear President Biden say much about that at all. Is the Fed really, should it be that independent from what's going on in the country?
Well, the reason you didn't hear President Biden say very much about inflation is because the Federal Reserve right now is in an absolutely nightmarishly difficult position. Now, the immediate reason for that is that it has these twin goals of low employment and keeping inflation under control as well. But it's very likely that in the coming months, we're going to see inflation spiral out of control while employment still isn't anywhere near what the Fed wants. So there's a big cognitive dissonance there about what on earth the Federal Reserve is going to do about that. Plus, of course, the fact that you've got asset price inflation that's been going up and up and up and up, and yet somehow the Fed only looks at consumer price inflation, which just doesn't make much sense in terms of how people live their lives. But the other big issue is that the Federal Reserve has sort of convinced us in recent years that it's almost like this sort of high priest of the American economy, where it has these seemingly magical powers and this continuity to keep the show on the road, no matter what happens in politics. And, you know, the Fed leaders are there for a lot longer than many other politicians. And it's created this aura of omnipotence. And yet the reality is that if you look at what's happening right now, there's not a lot the Fed can actually do about inflation because it's been driven to a large degree by supply chain problems, by the fact you just had this massive fiscal boost. So the Fed's simultaneously trying to convince us that it has control over inflation, but the reality is it probably doesn't. And on top of that, you have the fact that, the Fed pretends that it's somehow changing the economy and the financial system by moving the price of money by minute degrees or changing how it buys bonds. But in reality, what's really driving sentiment is what it says. It's verbal intervention. You might even call it voodoo. So there's a lot of cognitive dissonance in the way that we see the Fed at the moment. And I think for that reason, it's going to have a tough time in the months ahead.
Well, and I wonder, Jillian, how much of the Fed's power is really derived from its credibility and the fact that we believe in it, we trust it for one reason or another. Part of that trust comes from the fact that we don't think it's merely something that reflects exactly what is going on moment to moment in the polity at large. At the same time, do we really trust an institution to have that much power if they don't listen to us at some general level? And specifically, isn't the appointment process that we just saw this week with President Biden, isn't it that one limited way to have some influence over the Fed?
Absolutely. I mean, what's been fascinating this week is you've seen Congress pushing for much greater say on the part of the progressives in terms of who gets appointed. But the reality is that there's a lot of sort of almost mystical magic around the Fed. It's a bit like the priests in medieval Catholic Church who spoke Latin and the congregation didn't, but the congregation relied on the priest to provide the blessings. I mean, most people don't actually understand what the Fed's doing or what it says most of the time. And of course, it's not elected. Again, that's another point of cognitive dissonance because so much of the American self-perception is driven by this concept of democracy and being accountable, and the Fed's independent. So I think, there are a lot of questions about the way that the Fed maintains its credibility going forward.
So Jillian, with your background in anthropology, having studied, including in the field, various cultures and the way they interact, there is someone given credibility, some magical powers in almost every society. Give some advice to Jay Powell right now as he continues apparently to be the chair of the Fed. What would you tell him in terms of what he needs to do and avoid doing in order to maintain that credibility instead of risking losing it?
Well, I think there are two things. One is to recognize that we, as a wonderful anthropologist Douglas Holmes said, we live in an economy of words where it's not just about the financial system being like an engineering machine where you tweak a lever and something else happens. It's also about casting spells with your words. And that's a tough thing to do. The second thing I'd suggest is that they remember that actually independence is quite a recent phenomena by history. It's not a guaranteed thing. And I would imagine that as interest rates creep up at a time of a massive public sector debt, there's going to be growing pressure on the Fed to monetize that debt in some way. And that's going to create a very difficult challenge. I'd also point out that there are other really practical issues which they have to grapple with, like the structure of the Treasuries market right now and the degree to which they can or cannot make that stable. But one last big point, and this really is 101 anthropology, is that anyone running the Fed has to think very hard about the nature of trust today in the American system. Because trust can be created on two levels. It's either vertical trust, where people trust in leaders or institutions, or horizontal trust, where you trust the peer group or the crowd. And historically, horizontal trust could only be created in small face-to-face groups that knew each other. But digitization has enabled us to create horizontal peer group trust on a massive scale, what they call distributed trust. And things like Bitcoin and the other cryptocurrencies rest on peer-to-peer trust, not trust in an institution. We've had for the last 30, 40 years, trust in institutions, in authority figures, really dominating in a lot of the financial system around the concept of money. But the interesting question is going to be that if the Fed faces an increasing challenge in maintaining its aura of permanence, invincibility, independence, credibility, are we going to see people put more faith in peer-to-peer systems of trust, like these cryptocurrencies, rather than just automatically taking what a leader, i.e. the central bank governor, actually says as gospel?
Well, and Jillian, just to pick up on one thing you said, the structure of the Treasuries market, one of the reasons that President Biden gave for reappointing Jay Powell was how he handled the situation when there was a real crisis when the pandemic hit and got us out of it by a huge flood of liquidity in the marketplace. At the same time, you wrote a column saying, don't count on that structure holding up.
Well, there's good and bad news about what's happened with the Treasuries market in the last 18 months. The bad news is that we had a market that's supposed to be ultra liquid freeze up last spring. And that was terrifying because of the systemic implications. and doubly terrifying because it took a long time for policymakers to actually work out what had gone so badly wrong. Now, we have some of that answer now, which is to do with foreign institutions selling treasuries, to do with hedge funds having big leverage positions with derivatives, also to do with the fact there weren't market makers and activities moved onto electronic exchanges. So all of that is now better understood. We came out with a report in the last couple of weeks actually on this from a special commission. The problem is that no one knows exactly how to fix it, and the chance of action to fix it quickly is very low. Because you have people like the SEC saying, well, obviously what we should do is regulate high frequency trading groups. We should have a lot more transparency about positions, people reporting their position in the treasuries market. Maybe we should have a central clearing system. All of that is pretty sensible, but none of it is going to happen remotely quickly. So the reality is we're moving into a period where potentially we're going to have inflation for some time, interest rates potentially going up quite sharply at a time of massive debt. We just don't know how the markets are going to respond. But what we do know is that there's a risk that if there's a shock or a jolt, the actual system, the structure of the treasuries market may not be able to keep as much liquidity flowing as it has in the past. And frankly, that's a pretty alarming thing to think about.
Okay, Jillian, it's always great to have you on Wall Street Week. Thank you so much. That's Gillian Tett of the Financial Times. Coming up, it's the holiday season, which means, of course, shopping. We talk retail sales with a true expert, Jerry Storch, longtime head of Toys R Us, about what to expect this year in retail.
Sales are actually booming, and I would expect holiday sales to be up double digits versus last year.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It is holiday time, and that means for all of us a time to go out and get those gifts for everyone. And we thought it would be a good time to review where we are on the retail sector right now, particularly with Black Friday in the United States happening right after Thanksgiving, which is the official start for the season. And when it comes to retail, there's no one better to talk to than Jerry Storch. He, of course, is the longtime chairman and CEO of Toys R Us. He is now the CEO of Storch Advisors. So, Jerry, thank you so much for being with us. Let's start with the most basic question. We hope we're kind of coming out of the pandemic. Where's retail in recovery from what the pandemic did to it?
Look, overall, we're more than back. We're beyond any expectations. Sales are actually at unprecedented levels. This really began last spring, and sales have been accelerating ever since. We've heard all kinds of stories about, slowing down over the summer because of Delta or this or that. The supply chain was scaring people, inflation, all the rest. But when you look at a two-year stack in sales, that is, compare sales today to sales 2 years ago before the pandemic, they've been running up more than 20%, up 22% versus 2 years ago in the most recent sales report, which covered October. 22% in 2 years. And even the normal best of times, that number should be half of that. So sales are actually booming, and I would expect holiday sales to be up double digits versus last year.
How even is the recovery? Are there some parts of the retail sector doing better than others?
Well, there are certainly winners and losers, as there always are. The winners are those that were well positioned before the pandemic, and a few companies that are having kind of a dead cat bounce based on pent-up demand. So the biggest winners are Walmart, Target, Home Depot, Lowe's, Amazon, Costco, giant retailers with broad assortments, the ability to navigate this environment, to get those goods on the floor, and consumers have been flocking both to the physical stores for these companies and to their websites. So they continue to grow at tremendous rates. A few other companies have done well during the fall that you might not normally expect strategically to be that well positioned. People like a Macy's or a Dillard's or a Kohl's, companies with strong apparel businesses or department stores. But I warn you, the pandemic does not fix a broken strategy. And so some of what you're seeing here is that people were not buying clothing during the pandemic. Now they're coming out and they're buying those goods. Those are not long-term good bets. They have to revolutionize their business model to succeed. That's quite different from the first companies I mentioned, who already have a winning business model and are just putting their foot on the accelerator and growing even faster.
So Jerome,
Also, no discussion of retail would be complete without mentioning Amazon. I'm sorry, just have to go there, right? And Amazon stock hasn't done very much this year, and in some ways, I think that's a huge opportunity because they continue to be the class act of the dominant growth segment in retail, which is e-commerce. So, whatever you may think about Amazon one way or the other, or back to the politicians, everyone else trying to muck around their business, they are the only one who can deliver consistently, no matter what happens to everyone else's supply chain.
I want to come back to Amazon. Before that, just let me pick up on something you said before. 2-3 years ago, I had the impression that department stores, the general department stores, were definitely in decline. Has this changed that at all, or will they remain in decline apart from what you call the dead cat bounce?
Well, I think over the long term, they're still in decline. In the short term, they've picked up quite nicely. But keep in mind, they've lost such massive amounts of market share that when you look at the overall retail sales pie, they're actually kind of irrelevant already. The game's almost over. Sears is gone. Penny's went bankrupt. There's just a shadow of what they used to be. You've got just a few Lord & Taylor went bankrupt. We just got a few of them left, and those have not been growing significantly. I mentioned that 2-year stacked in growth that's up more than 20% for retail sales as a whole. The department stores are struggling that same 2 years to get over 10% growth, despite the fact that no one was even buying anything from these stores. They were steeply negative last year. So I don't see this as a long-term win. They will tell you, oh, look, it proves our strategies are working. Macy's will say, look, it's just like what we did in Polaris, Ohio, our model store. It's working everywhere now. Well, I think they're fooling, almost no one but themselves when they say that, because that isn't going to fix anything. To fix a business like that, you have to change who you are to the consumer. And let's be honest, today's millennials do not want to shop where their grandparents shop. They don't want to go to a department store. There has to be more fundamental change.
The supply chain problem is going to crimp retail style this season?
Well, somewhat. It's been running up over 20%. And I put out, versus 2 years ago, that's been accelerating, even as we get these bigger months like October, which is the biggest month that we have reported so far. November and December are big months, so you may say, well, we get to those giant months. Are you still going to grow 20% year over year? I think the answer is yes, and it might have grown 30%, believe it or not. The exports from China are running up 30% on that 2-year stack, and the problem is they're stacking up at the port, and all 30% is not getting through the pipe and getting to the stores, as we all know. So that's what the crimp is, but it doesn't mean we won't get that 20% growth. And if holiday sales, which they did, grew 8% last year, that leaves 12% growth to get to that 20% for a holiday period, which is a good number by any measure. It doesn't mean everything's going to be available in unlimited supply, nor was that always the case, by the way. I spent a lot of my life running Toys R Us, and the hot toys always sold out, got to tell you that. But meanwhile, this year, probably more hot products will sell out sooner than in other years. But there's still plenty of product out there. These big retailers have stocked up. They have the inventory. They've told you that. They've all said, we got it, and they do. And if you go to the stores, you may see some empty shelves, but most of them will be full, thank you, and you'll be able to get all the holiday presents you want. Not all the exact presents, but you'll certainly get a great present.
All the presents you want at what price? Because historically, like Black Friday, we hear all these amazing sales, you get all these discounts and things. We got a lot of inflation going on right now, a lot of prices going up. Most consumers you talk to are just talking about how rapidly the price increases are coming. How's it going to affect this holiday season?
So inflation's going to continue. I have no doubt this is not a transitory thing or whatever. It is getting built into the system in so many ways. Retailers, for example, can't hire right now very easily. So they're having to raise wages to levels they sort of aim to get to, but now you're like, oh, we're going to get to $15 an hour. Now they're like at $17 an hour. It depends on the market that you're in, but wages are going up very rapidly. All the government programs, those are already passed, the infrastructure program. Who's going to build those bridges? They need more people. So there's no way there's not going to be inflation, labor costs, inflation, other costs, supply chain costs for a long time to come. So inflation is real. The inflation, though, if you look at it in historical context for retail, doesn't really start to hurt the retailers until it gets up in the double digits. When it's at the level it is now, retailers generally can pass those prices along. I think some of them tried too hard not to pass it along. One of the biggest pieces of advice, by the way, I give to my retail clients is, try to front run the price increases. Take as many as you can when you can. that hasn't seen, people, oh, I want to show that I'm caring about my customers. Well, you need to care about your profits too. So I do think the retailers will pass those prices on. The consumer is flush with cash. By and large, there has not been a lot of price resistance. I think they're going to take those price increases and continue shopping. We heard from a retailer this week like Best Buy, who said that discounts and promotions were actually hurting their margin rate. So they have been discounting pretty heavily off those inflated rates, prices, trying to keep the prices down. I think they may have tried too hard. They didn't need to. Their sales beat numbers. Their profits beat their numbers. I think as we look forward, more retailers are going to figure this out, that you still have to sustain the gross margin rate and your expense rate. And as sales rise, it means that you're going to make a lot of money.
As I say, when it comes to retailers, nobody we want to talk to more than Jerry Storch. Thank you so much, Jerry. He is the CEO of Storch Advisors. Coming up, we take a look at the week ahead on global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now to take a look at what's happening next week on global Wall Street, starting with Annabelle Drewlers in Hong Kong.
Thanks, David. Well, this week in Asia, we'll be focusing on key economic releases. PMI data from China is the headline act, with expectations the manufacturing gauge will remain below 50. GDP figures are also due from Australia, South Korea and India. Sticking with India, fintech giant Paytm will be a watch on Monday. It reported earnings Saturday, which was the first since Paytm listed in one of the worst debuts by a major tech company globally. And finally, in Myanmar, detained leader Aung San Suu Kyi will learn the first verdict in a series of 11 cases against her on Tuesday. To Laura Wright in London.
Thanks, Annabelle. Here in Europe, eyes are fixed on the discovery of a new mutation of COVID-19 emanating from South Africa and whether that will force European governments to impose more precautionary lockdowns. Inflation in focus, CPI data at the beginning of the week from Germany, France, Italy, Spain and the Euro area. Earnings from EasyJet, the low-cost short-haul airline, on Tuesday. On Thursday, an OPEC meeting will be taking place. And the end of the week, the European Banking Authority released their annual risk assessment report. Taylor.
Thank you, Laura. A lot here in the U.S. Starting Tuesday, Federal Reserve Chair Jay Powell going to be defending his renomination at the Senate Banking Committee hearing, along with Treasury Secretary Janet Yellen. They'll be speaking Tuesday and then again on Wednesday. Thursday is also another big day. We're getting some quarterly results out of Dollar General. Remember, they operate the discount chain of retailers. A lot of concerns about higher inflation, higher freight costs, higher wages, and the impact that may continue to have on margins. Finally, the main event, Friday. It is Jobs Day. Really going to be looking to see if the labor market continues. That's going to be the numbers for November. Remember, back in October, the job market added about 531,000 jobs, beating estimates, and the jobless rate fell to 4.6%. Certainly keen to see if that trend continues. Back to you, David.
Thanks to Annabelle, Laura, and Taylor. Coming up, we talk with special contributor Larry Summers about the future of the Fed now that we know who will be leading it.
They overdo it on restraint. The economy could easily tip over, especially given how much euphoria there is built into markets. So it's not going to be an easy set of maneuvers for the Fed.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The big news of the week was President Biden's decision to nominate Fed Chair Jay Powell for a second term and also to nominate Lael Brainard to move up to a new position as vice chair. And there were a lot of people weighed in, and pretty much there was broad support across the entire spectrum.
I think the president made a fine choice.
This is sort of the dream team.
I think this is a don't rock the boat move.
There certainly is not going to be any conflict on monetary policy.
This is the central case that the markets expected.
To not reappoint Powell would have been quite negative for the markets.
The announcement today is going to give the market more confidence to move ahead with the pricing of rate hikes for next year.
It's not my expectation that we'll get a faster taper.
We still have the Fed on wait and see.
They stick with the current pace and then hike once you get to the end of that.
We're at a point in the economy where stability is really important.
Continuity.
Total continuity.
It means that we will be able to spend 100% of our attention and focus on really trying to discern what's happening in the economy.
One of those who expressed some support for President Biden's decision was Larry Summers, our very own special contributor here on Wall Street Week, former Treasury Secretary, of course, now with Harvard. So, Larry, thanks so much for being back with us. Give us what you took away from this announcement and what was said around the announcement, perhaps even as important as the announcement itself.
So I think the president made a good choice. Jay Powell, in the fullness of it all, has done an excellent job at the Fed. Lael Brainard is an experienced and capable monetary policy operator. I think it's a good team. It's a team that'll have some creative tension in areas like regulation, in areas like the environment, but I think it's a very good team at the helm of the Fed, and I was glad to see the president's choice. I was equally glad to see what the president said in announcing them, what Chairman Powell said, what nominated Vice Chair Brainard said, because they all recognized what has been true for some time, that overheating and inflation are right now the central macroeconomic problems facing the American economy, and there was no good outcome for the American population, for the American middle class that is so dear to President Biden, without taking steps to get inflation under control. And I think that the rhetoric you saw from Chairman Powell and Vice Chair Brainard portends a new era here for the Fed. I think the question the Fed is now managing is not, do we have an overheating problem? Can we bet with Team Transitory? They know we do have an overheating problem and that they can't place their bet with Team Transitory. They've got a new problem, and it's a very complicated one, and I very much hope they'll be very thoughtful about it, because there are no easy answers. The new problem is, how do you land this economy softly? That got corroborated by the numbers we saw. PCE deflator was very strong. Even more important, the income and spending numbers were stronger than we expected. The revision of the national accounts revised upwards how much income consumers had. That means it revised upwards how much pent-up savings ready to spend they have. So all the numbers are pointing towards a lot of strength. All the numbers are pointing towards limited capacity. You know, we've been saying for a long time now that vacancies are record highs, quits are record highs. We got another number in that direction this morning. Unemployment insurance claims lowest since 1969. And of course, we've got a lot more people than we did then, so that makes it an even stronger statement. So we're looking at a challenge of slowing an overheating economy. And we know from the research of a number of people that that's a very difficult thing for a central bank to do. It's particularly difficult when, frankly, it's late to the party to recognize the overheating, and when they have only an instrument, monetary policy, that works quite slowly through the economy with lags of 9 months to a year. The Fed very foolishly asserted that it wouldn't ever start raising monetary policy until we were at full employment, which, given the lags, was much too strong a statement. And they're going to have to figure out how to maneuver within their framework, which, when it was put forward, didn't contemplate anything like this moment to provide the necessary gradual restraint. If they overdo it on restraint, the economy could easily tip over, especially given how much euphoria there is built into markets. So it's not going to be an easy set of maneuvers for the Fed. But they now, I think, recognize what they're dealing with in a way that as recently as a couple months ago in Jackson Hole, they did not.
So, Larry, it's clear to me, I think to everyone at this point, that many people have moved in your direction. You were very early on saying we're putting too much money in the fiscal stimulus in the last package. You're going to have inflation. We now have inflation without a doubt. But I wonder if you are that confident that everyone agrees with you that there's going to be overheating that really needs to be addressed right now. Because we do have some people. We talked to Paul Krugman. You and I talk about him regularly here. You know him well. I know you respect him. We talked to him this week, and he said, yes, absolutely, there's inflation. Yes, there should be tapering. But we've got 2 or 3 factors that make us less concerned about it. Number one is fiscal stimulus is working its way out, not necessarily. We're going to be contracting on the fiscal stimulus given where we were. We've got a COVID out there that's undetermined, and in fact, the supply chain thing is getting better. So there are some people who think, yes, there's a problem, but it may solve itself to some extent.
Paul's been wishful thinking on this for 9 months, and I think he still is. With respect to the fiscal policy, we've still got very substantial levels of spending to come from the fiscal policy we've already done, and we've got new fiscal legislation that'll increase the deficit by $160 billion in the legislation if it's not amended in the Senate. The forecasts, which call for continued reductions of a substantial magnitude in unemployment, even given the super high vacancy rate, so further tightening, already assume all that Paul is saying about the fiscal policy. So I think he's pretty unlikely to turn out to be right in his fiscal policy argument. Nobody knows what's going to happen about COVID. What's kind of remarkable about people like Paul and some of the others who have just, I think, been deniers and hopers on this is that if COVID's bad, they think that's a reason for more stimulus because we need to support the economy through COVID. And if COVID's good and goes away, they think that's a reason for more stimulus because we're going to get more supply. And they try to have it every which way. I think that COVID has left scars. The labor force participation rate is not going back to where it was anytime soon. Reams of empirical data suggests that the best predictors for knowing what's going to happen to wage behavior actually come from the demand side, come from things like the vacancy rate. Every business you talk to says the same thing. We have a shortage of labor. We're going to have to pay wages. We've done about all we can with recruitment bonuses and the like. We've got rising costs, and we've got a lot of pricing power to push on those rising costs. How, in the face of the universality of anecdote, anybody but an academic economist could say that this is all going to recede in the next 6 months, I cannot, in all honesty, fathom. And I think it's very interesting. I started to see today, reading some of the commentaries, people saying, well, the supply chain problems are going to be with us till early 2023. This is like being at the airport on Wednesday night before Thanksgiving, and the flight's going to be at 6 o'clock, and then it's going to be at 8 o'clock, and then it's going to be at 8:30, and then it's going to be at 9:30, and then it's going to be at 11. Yeah, sooner or later, we're going to work through all of this, but I think we're still in the early innings of inflation pressure. And what I have noticed very strongly is the closer you get to people who are in the actual economy, people who are hiring, producing, and pricing, the more scared they are. And the people who are most serene are, respectfully, the people who are most remote from the actual experience of the economy sitting in their studies.
Okay, Larry, we're going to ask you to stay with us if you would, please, because as important as that monetary policy is and the Federal Reserve, there are also issues on the fiscal side, and there's a question whether the Biden administration needs to make something of a mid-course correction on fiscal policy. We're going to ask Larry Summers, our special contributor on Wall Street, coming up. That's coming up next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We've talked about the Fed and monetary policy. Let's turn now to fiscal policy. The Biden administration now, at the end of its first year, must be thinking a little bit about whether there are any mid-course corrections it might make, specifically on the question of inflation that Larry Summers has talked so often about. Larry Summers, our special contributor, has remained with us. So, Larry, what about what the administration could do? Put aside the Fed, what the administration could do on the front of inflation.
So look, I think we need to be honest and we need to recognize that the main action, the overwhelming action, is with monetary policy and it's with the overall posture of fiscal policy. The overall posture of fiscal policy has been substantially set, unfortunately set, by the mistakenly large fiscal stimulus that was enacted at the beginning of 2021. The administration's moving towards doing the right things. The SPRO release was probably a constructive step, but as we saw, they released the SPRO, and immediately after the SPRO release, the price of oil actually went up. That's because the release was a little smaller than many people expected. It's because unlike after Libya, the Europeans didn't join in the SPRO release. It's because the whole thing had been widely telegraphed for the last few weeks. So probably if this whole SPRO thing had not happened, oil would be a few dollars higher, but we've kind of done it and we are where we are. I think the administration should do what it can to encourage oil supply in the United States, but I think it's mostly developments in capital markets, not public policies that are driving where we are on oil. So I think there is low-hanging, I'm sorry.
I was just going to say, just to be clear, SPRO is the Strategic Petroleum Reserve. For some people who aren't as conversant with this as you are. But you're going to say low-hanging fruit. I was going to ask about other possible regulatory relief, such as tariff relief, for example.
So I think the administration does need to find its way to more rapid action on tariffs. I think it's plausible that they could take up to 0.5%, maybe even 1% out of the inflation rate over the next 18 months with properly strategic tariff reform. But that's going to require them to adopt a more forward-looking attitude towards trade than they have already. I think if they could emphasize buy cheap rather than buy America, that would be constructive as well. I think as they look at their various regulatory agendas, they need to think about which ones are imposing costs on business and be careful. These are all steps that I think are significant, but they're not ultimately what is going to determine the outcome. And while I've tried to speak to them, I think it's very important not to divert attention from the central issue, which is the management of demand and the recognition of overheating. The truth is that we don't have slack in our labor market today. And there isn't room for more demand to employ more people without unsustainable inflation. And I wish it was otherwise. The people who say that more demand does enormously good things for disadvantaged people are absolutely correct, but you have to do things that are sustainable if you want them to be sustained. And we're in the unsustainable place right now. in terms of how hard we're pushing and pressing the economy.
Larry, let me ask about one other regulatory initiative potentially. We've heard President Biden more than once say he wants the FTC to look into the oil companies, whether they're gouging right now, if I can put it that way, because the price of oil going down has not been reflected at the pump. There are reports from Bloomberg and elsewhere that perhaps the administration is thinking about a broader ranging use of antitrust and perhaps other laws and regulations to really go after people that they think are passing along price increases. Does that make sense?
Look, we need stricter antitrust enforcement in America. One of the things I'm encouraged by about the Biden administration is that they're going to bring us stricter enforcement of the antitrust law in America. That is a very important thing. Where there are abuses, they should be corrected. If anybody thinks that gouging is an important cause of our current inflation, they are dead wrong. And a policy approach to inflation that put some theory of gouging or exploitation or bad corporate behavior at the center of policy would be economic ivermectin. It would be a dangerous and false diagnosis and prescription for a very real and serious problem. I think the administration won't go that way. I certainly hope it will not go that way. And if it does, it will be a very dangerous sign that they are overly responsive to the hard Democratic left, which I have to say I think has been the source of many of their difficulties.
When we turn back next week to the Build Back Better plan, we'll have Congress back in session. They're going to be negotiating it some more. You've said you don't think on balance it's that bad on the inflation front. You think there are a lot of good things in there. But what could be done to improve it from your point of view?
Let me be very clear. If I had to vote up or down on it, I would definitely vote up. Let me be equally clear that I think over time it will make substantial contributions to making American society both richer and fairer and more sustainable in its environmental impacts. That said, I'd be more comfortable with the measure, David, if there wasn't quite as much fiscal stimulus in the first few years. And I think there's an easy way to achieve that. The state and local deduction, the increases in the state and local deduction that were not in the administration's proposal, but were inserted in the House of Representatives, are, I believe, misguided. They are retroactive, and the one thing we know is that retroactive tax increases don't have any positive incentive effects. They give relief to people like you and me who are not the people who really need help in our economy. I mean, there is something wrong. There is something deeply wrong with a democratic revenue-raising measure that cuts the taxes of people like you and me who are almost certainly in the top 10th of 1%, because we've been very lucky and fortunate of the income distribution. And we could make that better by scaling way back the state and local deduction proposal. And in the process of doing that, we would also reduce the inflationary pressure that would come from the bill.
Larry, finally, instead of outrage of the week, let's talk about giving thanks. This is, of course, Thanksgiving week in the United States, where we celebrate Thanksgiving. Give us a sense of what you think we should be thankful for.
David, I've certainly on your show and in other places been critical of a lot the administration has done, of a lot that the country has done, and there's a lot to worry about. But nobody would have expected that we would create as many jobs as we've done over the last 12 months since the last Thanksgiving. I think we can take some real satisfaction from the fact that we're now, I think, in the bottom of the seventh inning with respect to COVID. It's not going to go away, but it's going to become just part of life that people accept. So I think we got a lot to work through, but I think better times are ahead.
Okay, we can certainly hope that's true. Thank you so much, Larry. Always a treat to have you with us. That's Larry Summers of Harvard. Coming up, a Wall Street Week look at what we have to be thankful for this holiday season. This is Wall Street Week on Bloomberg. Finally, one more thought. Remembering to give thanks. Going into this holiday season, there's a lot on all of our minds. There's a supply chain that seems like it will never get fixed, with the Rivian CEO saying it is really the biggest problem out there right now.
I would say the biggest challenge that we have, and I would say broadly across many industries, is really the health of the supply chain.
There are spiking energy prices, complete with release of strategic petroleum reserves. Here's Anastasia Amoroso of iCapital Network.
It does set up a bit of a fight here, I will say, because clearly that's not something OPEC Plus wanted to see happen.
And there's even the prospect of a Russian invasion of Ukraine.
The Russians are building up to an extraordinary degree opposite Ukraine. Whether this is simply a show of force in order to muscle Ukraine, to persuade the government there, say not to move closer to the West, or whether this is the prelude to an intervention in which they would take over enormous parts of the country, conceivably even the capital. I don't rule anything out at this point.
That's Richard Haass, president of the Council on Foreign Relations. But let's be honest. There's one issue that looms larger than all the others, the COVID virus and the possibility it could once again spoil the holidays. Here is WHO spokesman Christian Lindmeier on the new variant, first identified in South Africa on Friday.
It will take a few weeks for us to understand what impact this variant has. Researchers are working to understand more about the mutations and what they potentially mean for how transmissible or virulent this variant is, and how they may impact our diagnostics, therapeutics, and vaccines.
And while much remains unclear, we do have the vaccines and the boosters and the pills. Pfizer confirms it could make a variant vaccine in 100 days. And as Dr. Anthony Fauci says, we are prepared to do anything we need to do.
First of all, you want to find out if, in fact, it does evade the vaccines that we're doing. I mean, there's always the possibility of doing what the UK has done, namely block travel from South Africa and related countries. We don't know that. That's certainly something you think about and get prepared to do. You're prepared to do everything you need to do to protect the American public, but you want to make sure there's a basis for doing that, and that's what we're doing right now.
So there is still a good deal to be thankful for this holiday season, despite some uncertainties. And much of it comes from those vaccines, including for 2 Thanksgiving turkeys named Peanut Butter and Jelly. The President Biden suggested were spared in part because they'd gotten their shots.
Peanut Butter and Jelly were selected based on their temperament, appearance, and I suspect vaccination status. No, is it? Yes, instead of getting basted, these 2 turkeys are getting boosted.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.